Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, in a market with promises of sky high returns, many investors wonder if it is possible to get high returns. High returns? 25% or more. So, in today's episode, we'll separate facts from fantasy and we'll try to make sense of how much is possible and what is long term investing and discipline is all about. Welcome, Dhirendra.
Thank you.
So let's dive right in. A lot of questions that we get here at Value Research are all about, getting high returns from their investments, mutual fund investments. In fact, today's episode is based on one such query. So is 25% plus annualized return possible from mutual funds?
Markets do give good returns over a period of time. There could be a greater premium for having a good portfolio or also sometimes luck. Some combination of these factors, also the timing. But to expect that it is a 20% yielding fixed deposit or 25% yielding fixed deposit, that is completely baseless and wrong, and it just can't be there. Because that is the design of the market. This 40, even if you earn 20%, 18% or 25% return, this will come in these 2, 3, 4 formats. Either it will be, you'll generate a lot of return and then you lose it all and then it'll go up again, and you will benefit from that only if you stick around. Second is that, you will invest and it'll go down and then it'll go up again. You still need to stick around. So all these 20-25% return expectation, it happens, but it happens over 10-15 years. And then it'll come with plenty of minus 25, minus 50% return as well. Minus 10%, minus 20% is fairly routine. Even 2023, the Sensex return was, nearly 25-30%. So it might look a very normal thing to expect. But that's not true. It is followed by a decline. It is followed by a nominal return. It is followed by 1% return. It is followed by, minus 10% return. Are you ready for it? So this is not going to be a very consistent, nice, smooth line going up. People have changed the definition of volatility. Everybody thinks that volatility means something goes down. That's not true. Volatility means something goes up and down, and it's the extreme volatility that you will experience and you have to live with and get used to. That it translates into something like a decent, handsome return. So expect decent return for an all equity portfolio if it is well managed, high quality, and you are also lucky. And then you have the patience and the discipline. But don't expect it to be 25%, 20% year after year.
Since we're talking about it, there are some fund categories that delivered high returns over the past 3-4 years. Can you talk about some of those categories which have historically achieved such returns, and is it really possible to sustain that?
In investing, one thing is very simple. That in fact, that is the truth. That is the gospel truth, and it proves over a long period of time that the more you concentrate, the returns could be high and it will be more volatile. When you look at the character of equity performance, it's very straightforward. As things more volatile, they tend to yield greater return. More better performing assets or better performing segments of the market, they tend to be more volatile. And when you look at it from a mutual fund perspective, look at any narrow category, a sector fund, a thematic fund, or say something like small cap fund. It is just focusing on the small companies. It'll go up and down more. And that is what we have witnessed in 2008, which was the extreme, bad phase for the market. What we witnessed was, the small caps went down, even the large caps went down by 45, 50%. But small caps went down by 80%. Now, 80% is stomach churning. It's very difficult to withstand that kind of decline. Your 100 rupee, what you saw in the month of January, became 20 rupee by the month of October. And then they made a comeback. They came back in next, 6-7 quarters. But who was going to stick around? It is extremely difficult. So as category, narrow categories, narrow sectors, narrow themes, they tend to be like this. So are you really prepared for this? Look at this FANG Plus index. When we see a 2-3% up and down in an index in India, we think that it is a great day or it is a horrible day. It's an outlier. It's not a very usual thing. This FANG Plus index actually goes up and down by 3% every other day. It is so frequent that 3% up and down or plus minus looks like a normal thing. And when you look at the medium term, long term performance of this index, it turns out to be far superior. One is that NASDAQ 100 itself is good. And this is, 1.5, 2 times more than that. It turns out to be so much more rewarding. So there might be some premium for embracing this extreme volatility. And the more you concentrate by sector, by segment of the market, it tends to be, more rewarding.
But then why does everyone always say that diversification is the only free lunch?
Simply because, how many people can actually stick around with that investment after it has gone down by 80%? To be able to benefit from these higher returns, to be able to benefit from these concentrated strategy or a narrower strategy, you need to be through the full cycle.
Yeah.
And it's far easier said than, actually doing it. When you have seen that your 100 rupee has come down to 20 rupee, do you think, people think, that is when they capitulate, that is when they think that, okay, enough of it, can't take it anymore. And can't take it anymore can happen for a variety of reasons, but most importantly, it is your own temperament, it is your own attitude, it is your own comprehension of things. Because what happens is, if you need, and then the discipline, if you put your short-term money, you can't stick around. You have never seen this kind of decline. You have only seen the rising phase of the market. Then you won't be able to withstand. So I think, a lot more goes into it, the way you think. And after all, it's your money. If you're getting close to, if that money was tied to some specific goal and you see it vaporizing every day, it gets very difficult to stick around.
Yeah. So while you did touch upon some of the risks and trade-offs that one should be mindful of, if you could elaborate on them, what is it that people should be mindful of while expecting such returns?
The real risk of this kind of expectation is that you are extremely vulnerable. Somebody can take you for a ride. That's one, because these are not realistic return. And one is that even if they turn out to be realistic return, you can't start with the premise that this is what I have to get. There is a possibility there will be many investors, there will be many equity investors who will be able to earn 20% and more return over the next 15, 20 years maybe. But you really don't have to start with this expectation precisely, otherwise you will always be disappointed. There will be, of these 20 years when you will be very happy overall. In 10 of the 20 years or 15 of the 20 years, you will be disappointed because that will be minus 2%, plus 5%, plus 7% lower than fixed income. It's only that, equity tends to compensate in a very narrow period. Sometimes the market will go up by 50%, 100%. It has happened so often that there will be a pent-up, valuation or something, or a demand or a convergence of things which drives this market. And markets are very erratic. So that is what actually builds your return. Not that, 20% year after year. It is not a, 20% yielding deposit. So that's one. Second is to actually be very rational about, why you are getting this return. It is not that the stock market generates return. Eventually, the companies make more money. Companies make money that drives their stock prices. And that over a long period of time is very much, aligned to the earnings growth and earnings capacity or earnings of individual companies. And this is an aggregate. So if you are lucky with a bunch of stocks through a mutual fund, which turns out to be extraordinary, and then you are able to tide over and you don't get out at the wrong time, you don't get in at the wrong time. All those things are just as important. And don't run away when you are faced with that 50% decline.
Yeah. So it's important to be cautious and not just expect those high numbers, but what then is a realistic expectation?
My definition of realistic expectation is with a not so aggressive portfolio, I should be able to generate 25% more than what I earn in fixed return. The risk-free return. And for me, the risk-free return reference is, a conservative reference is, 1 year deposit rate of a State Bank of India. That is a risk-free return, almost risk-free return available to every Indian in the country. We have more SBI branches than McDonald's. And, a safe distance will be, for every 4 or 5 kilometers, you'll get one. So that is something which is fairly democratized in this country, and a bank which is still substantially owned by the government. Every reason to assume it to be a democratized deposit, which is almost risk-free. A conservative investor in equity and looking at aggressive hybrid fund or a balanced fund, then my expectation will be, it will beat the fixed income return by 25, 30, 40%, depending on the allocation. If I am actually even more aggressive, then maybe 1.5 times or, nearly 2 times as the fixed income return. And this fixed income return is a function of multiple things. It could be inflation, it could be the prevailing interest rate, it could be the demand and supply for the money, it could be the economic recession, or it could be an economic boom. All those things, and these are very cyclical things, they are not a static number. We have had, a phase in this country where, for 40 years, interest rates were the same. No longer. Today, everything changes, inflation changes, and it gets passed on to consumers. We experience it every other day. Not that earlier it wasn't so. Just that, many other things were artificially controlled. And extremely, aggressive investor, a thoughtful investor with a temperament and a long-term view, he ends up with, something like 2.5 times of the then prevailing interest rates over time.
Right.
And that could be 20%.
Yeah. Okay.
And the most important thing is to have a modest expectation so that you are pleased with your return and so that you can stick around.
Right. So a solid investment strategy would be to stick around for a long time and set realistic expectations, diversify well, be patient. Now, moving on to viewers' query. Vidya Iyer, 58-year-old Vidya Iyer says, at the moment, my allocation is 67% equity and the remaining debt is purely retirement allocation. I have excluded the amount kept separately for the child's education and the new house purchase. Am I doing it correctly?
I don't have complete information, but based on what he has shared, that the money for child's education and buying the home, which he plans to, is separately earmarked. Now comes, how to look at it. I don't have the full context in terms of what is the income requirement and what is the scale of this investment. But assuming, I would like him to take a broad, check that this 100%, 67% into equity, 33% into fixed income, what is this amount? And what is his income in retirement requirement? Depending on, because if you're going to get a pension, if you're going to retire from the government, you might get some pension, and then, what will be your income requirement from this 100%, 67% and 33% into fixed income? Depending on that, because there if you have 5 to 6% of withdrawal need on the total money, because what will happen is that you will mount your SWP from the fixed income, and you will let your equity grow, and equity will grow over a period of time much faster than what you will actually be consuming. So looking at what percentage is your income requirement from investment is the essential check. Then comes the mechanics that whether you take it out from equity or whether you take it out from fixed income, whether you take it out from equity after it has gone up. This 33% has actually become 45% if equity has gone down, or equity has become 75% because it has gone up. So that is the mechanics of it. But most important thing is how much capital you have. Are you going to withdraw 5% or 6% from it? And if it is about that much, about 5%, you are fine. If it is going to be 8%, you need to worry.
Well, thank you, Dhirendra.
Thank you.
Thank you to our viewers for tuning in. Remember, smart investing is about discipline, patience, and sticking for the long time. Well, that's all we have for you in this episode. Keep watching The Space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.